There's a number of things conspiring, coming together, which are leading to a very, very acute shortage of silver. And we've already seen a lot of silver leaving COMEX. It's been drifting out of London for some considerable time. And I think that we're going to get another squeeze, which is going to make those 40% lease rates look like, if you like, the foothills of a mountain. The last things to die with the economy. So demand for silver for industrial purposes is really what's led to the supply deficiency over the last 6 years or so. The gap will not be filled by China. We've seen silver imports, China's silver imports in the first 3 or 4 months of this year. The inflationary consequences, the consequences for the CPI index of what's going on now in 6 months' time is that the CPI index will be rising at a rate well in excess of 10%. We go up nearly 4 times from here. We're looking at a level of around about 20% yield on the 10-year bond. Who's going to buy US Treasuries? Real oil crisis, when OPEC pushed up prices by something like 300%. It will probably go up somewhat more, 200%.
I've written recently about the appearance that the silver market is poised for a potentially large positive move. Any additional light other than what you've already explained about the destruction of the currency and so on that you'd like to share that guide you to think that people should keep their eye on silver in the near term?
Yes, I mean, silver is unique insofar as, unlike gold, it's also got an industrial, like a major industrial use. Gold has a minor industrial use. And that is, obvious. And that use is, if you like, not really dependent on economic activity. It's mandated by governments that, we've got to move away from fossil fuels and all the rest of it. So you've got EV, photovoltaic production. You've also got electric vehicles and so on and so forth. And obviously we're seeing defense expenditure rise. Now, none of these are sort of things that, if you like, die with the economy. They are the last things to die with the economy. So demand for silver for industrial purposes is really what's led to this supply deficiency over the last 6 years or so. And now that China has changed her attitude towards trying to suppress the price in the West, what's happening is that you're getting a growing amount of interest in silver as a monetary metal. And that, I think, is only just started. It's leading to, if you like, a crunch whereby the shortage of supply over the last 6 years suddenly is going to become very, very acute.
Silver demand is rising fastest in sectors governments cannot politically afford to let fail. Solar manufacturing alone consumed over 230 million ounces last year, while mine supply barely moved, creating a structural deficit most investors still ignore. As Alasdair Macleod points out here, silver is no longer just a hedge against inflation. It's becoming strategically essential to energy grids, defense systems, and monetary distrust simultaneously. That combination creates violent repricing risk for anyone underallocated to physical metals or miners. Next, Alasdair Macleod exposes why China's quiet policy shift may matter more than anything the Federal Reserve says publicly.
The gap will not be filled by China. We've seen silver imports, China's silver imports in the first 3 or 4 months of this year. There's been, record levels. There's something about their exports. They have been exporting some, but I don't know that it's been anything like what they've been doing in the past. And I think what China's doing, she's been reviewing her export policies quite significantly in the wake of the Iran war, the Gulf War. We've seen this with things like fertilizers and so on and so forth. And other people I've talked to who know better than me about Chinese policy, trade policy, they're saying that they're tightening up on all their commodity exports. We've seen this, for example, with rare earths. We saw this back in late September last year. And I don't think it was telegraphed at all, but we could see that something similar was happening with silver, because literally within about 2 weeks, there was a liquidity crisis in the LBMA. which drove silver's lease rates up to roughly 40%. And China is now in the situation because America turned around and suddenly decided I think it was about the last half of last year, that silver was a critical mineral and they needed to accumulate it. Now, was China going to supply this to America? No way. So you can see that there's a number of things conspiring, coming together, which are leading to a very, very acute shortage of silver. And we've already seen a lot of silver leaving COMEX. It's been drifting out of London for some considerable time.
COMEX inventories are draining while lease rates already touched 40%. Yet mainstream coverage still treats silver like a sleepy industrial metal. China has quietly tightened exports on strategic commodities at the exact moment the US classified silver as critical to national security supply chains. As Alasdair Macleod points out here, this is less about inflation trades and more about sovereign competition for hard assets behind the scenes. For precious metals, investors, that means paper liquidity can disappear far faster than retail expects during the next squeeze cycle. Next, Alasdair Macleod reveals why London's silver outflows may expose a hidden institutional panic developing underneath the market.
And I think that we're going to get another squeeze, which is going to make those 40% lease rates look like, if you like, the foothills of a mountain. But I mean, we're talking about a situation, I think, the inflationary consequences, or the consequences for the CPI index of what's going on now in 6 months' time is that the CPI index will be rising at a rate well in excess of 10%. I mean, it could be even more than that, because actually what we're seeing is not just, if you like, a shortage of this, that, and the other thing, and working through in terms of prices and so on. What we're actually talking about is a fall in the purchasing power of the currency. When you can see that that is actually what's happening when prices rise, it's the currency going down rather than prices going up, then a loss of confidence in the currency is going to exacerbate that considerably. And that is the situation we face. If you have a funding crisis, it will result in a fall in the confidence of the currency. So it becomes a self-feeding thing. I just can't see that this is avoidable now. It's called a debt trap. We saw, I mean, if you look at the chart of the 10-year or even the long bond, you'll see that from just post-COVID days, the yield on the long bond rose roughly, I think, from 1 and something percent, 1 and a bit percent, and it went up to just over 5%. Quite quickly. And then we've sort of consolidated for the last 2 or 3 years.
The Fed keeps talking about price stability, while long-term bond yields already tripled from post-pandemic lows. That divergence matters because inflation psychology changes permanently once people realize their currency is losing purchasing power faster than wages can compensate. As Alasdair Macleod points out here, the real threat is not isolated shortages, but a debt trap where rising yields weaken confidence, which then drives even higher inflation expectations. For retirees and savers holding long-duration bonds, that cycle can quietly destroy purchasing power before markets visibly crack. Next, Alasdair Macleod unravels why a breakout in treasury yields could trigger the very currency crisis policymakers insist is impossible.
Moving sideways. We're going to break out of that on the upside. Now, having gone up something like nearly 4 times, we go up nearly 4 times from here. We're looking at a level of around about 20% yield on the 10-year bond. Now, I'm not saying that's definitely going to happen, but I'm saying that that is the prospect. Under those circumstances, who's going to buy US Treasuries? Not even domestic investors are going to buy it, except pension funds who will be looking, if you like, at the actuarial benefit of higher yields. The rest of it, forget it. It's just not going to happen. And this is at a time when America's debt to GDP is in the order of about 120%. I mean, we had this, DK, we had this in the UK back in the mid-70s. The crisis that we had was one of inflation. It was very similar to this. It was in the wake of the first real oil crisis when OPEC pushed up prices by something like 300%. Now, this time it's not such a sharp rise in the price of oil, though that is yet to rarely occur in my view, but it is far more widespread in terms of its effects. Because in those days, in the 70s, they didn't have the refining capacity in the Persian Gulf. There was some, but there was very little. The result was that all the derivative products from oil and gas basically didn't exist in the Gulf at that time. So it wasn't a supply shock for all those products. But this time it really is. So this is widespread. So even though the price of oil hasn't yet gone up 300%.
Bond markets are behaving less like a normal rate cycle and more like the early stages of sovereign distrust. US debt to GDP now exceeds 120%, yet policymakers still assume global buyers will endlessly absorb treasury issuance regardless of inflation risk. As Alasdair Macleod points out here, the 1970s comparison misses something bigger. Today's supply shocks hit nearly every industrial chain simultaneously, not just crude oil itself. That leaves pension funds, retirees, and dollar savers exposed to both falling bond values and declining currency credibility at once. Next, Alasdair Macleod exposes why rising yields may actually accelerate money printing instead of stopping inflation.
It's only gone up 100%. It will probably go up somewhat more. So it could well go up 200%, maybe even 250%, I don't know. But even on what's happened so far, we're going to see what happened back in the 70s in the UK. Now, in the UK, we ended up with a sterling crisis. We ended up with bond yields rising to 17%, would you believe? 17%. The IMF came in and had to bail us out. And we were very lucky because then we discovered North Sea oil. Suddenly we were a petrocurrency. I mean, this was just, you know, the luck of the Irish, as they say, but the luck of the Brits. So this was absolutely amazing. The other thing which was key in this was that the debt to GDP, government debt to GDP, was in the order of about 35%. Now it's 100%. We're seeing a rerun of what's happened in the 1970s. But instead of 35% debt to GDP, we're now 100% debt to GDP. There really is no way in which we can expand our borrowing from there. You know, this is really the situation. So what does this translate into? It translates into a valuation for currencies, which is not just us, it's the whole of G7. It translates into a problem for the currencies, for the governments that issue these currencies. They will not be able to fund themselves almost at any price, except through very, very short-term debt like, 3-month T-bills sort of thing. So it's printing cash, if you like, on the debt side, and cash on the output side. And what's that going to do to the further confidence?
Governments keep calling deficits manageable, while refinancing costs are starting to resemble emerging market crises. Britain's debt-to-GDP ratio was roughly 35% during the 1970s sterling collapse, but today major G7 economies sit closer to 100% or higher, with far weaker fiscal flexibility. As Alasdair Macleod points out here, short-term debt issuance becomes the last refuge once long-term buyers stop trusting the currency itself. That means savers holding cash or sovereign bonds could face simultaneous inflation erosion and capital losses disguised as economic stabilization policy. Next, Alasdair Macleod reveals why central banks may accelerate currency destruction while publicly claiming they are fighting inflation.
If you like, in these currencies is going to undermine them even more. I mean, I think what we're seeing is something that's tipping us into something which is going to be almost impossible to get out of.
Your correct focus there on the realization by enough people that the crisis that is evidencing itself in the failure of the debt market by the skyrocketing of sovereign bond rates is actually going to cause, or is a symptom of, is certainly going to cause a destruction of the value of the currency at a rapidly rate. But it seems like in the past, at least in the U.S., it has been shocking how delayed the public awakening that it's the currency declining, not prices rising. Even back when we had Nixon, he did a 90-day price freeze on all prices, and Biden was saying, oh, it's corporate greed, doing all this shrinkflation and everything. Never from the halls of power have come the confession that actually it's from collusion since 1913 of the central bankers with the government and the treasury that we've been destroying your currency, and this is where the symptoms are showing up. Do you foresee an actual widespread enough awakening on the parts of enough people that there will be this mass recognition and acknowledgement? The emperor has no clothes, the currency, the cash is trash, and people will fly to something other than the dollar?
Eventually, yes. I mean, this is described by the great Austrian economy, Ludwig von Mises. Basically, from his experience of what happened in Austria in 1922, Germany 1923, was the last people to understand what was going on with the users of the currency. Until the very last moment, they think its price is going up rather than the currency going down.
The Fed blames inflation on consumers and corporations, yet its own balance sheet exploded by trillions in just a few years. That contradiction matters because history shows populations rarely recognize currency debasement until trust in government debt starts visibly cracking in bond markets. As Alasdair Macleod points out here, sovereign yield spikes are not isolated market events. They are warning signals that confidence in fiat itself is eroding underneath the surface. For households depending on fixed income savings, delayed recognition becomes financially devastating once purchasing power collapses faster than policy responses. Next, Alasdair Macleod exposes why the public always realizes the truth about currency destruction at the very last stage.
But when they finally realize that it's the currency going down, then the currency will not recover. It's the end of the currency. So that, if you like, is very much the last thing that will happen. And it's characterized by people just getting rid of currency for anything. What he described, or what's described in German, translated into English as the crackup boom. In other words, finally, there's sudden demand for everything. But that demand is a desire to just dump currencies, get out of it, before it's completely worthless. So that is the last thing that we will see. Meanwhile, I mean, I just feel that it's my task, and it's really through your good offices, to try and make as many people aware that this is what's going on before they get to that final point, and then say, I now understand what is going on. By then, the dollar will be, you'll need $1 million to buy a cup of tea. I mean, it's going to be a bit like that. So understand it early, really follow the process, understand the implications, understand how to protect yourself. And you won't be one of those people, the general public, who suddenly wake up at the end of a process where their medium of exchange is being completely destroyed.
First, a little joke and then a serious topic. At that time, when the public wakes up and there's this flurry of economic activity going on, what is your prediction that the official halls of power and the government mouthpieces in the mainstream media will be saying?
If confidence breaks suddenly, retirees holding large cash balances may discover safety was the riskiest position of all. History's hyperinflation cycles did not begin with panic buying. They began with years of public complacency, while currencies quietly lost credibility underneath rising asset prices. As Alasdair Macleod points out here, The crackup boom starts when ordinary people stop trusting money itself and rush into tangible assets regardless of price. For precious metals investors, that shift creates explosive upside, but for late savers it becomes a permanent destruction of purchasing power. Next, Alasdair Macleod unravels why politicians often celebrate inflationary chaos as economic recovery right before systemic confidence breaks.
Wow, look at this wonderful economic activity. We're having an economic recovery. All is well. It's back to happy days are here again.
Well, undoubtedly, I think a more important point is that we've got to understand that there's a process that's not going to be stopped by reason, by economists giving correct advice to government and all the rest of it, because the whole process is driven by politics. It's politics that matters. So when you have a situation where the government can either stop the rot and tell everybody, sorry, no more welfare, or we're cutting welfare, or whatever it might be, we're cutting out right back to the bones, we're going to balance our budget, etc., so that we've got a surplus. We're going to secure the value of the currency, but it's going to mean that businesses go bust in huge quantities. Or we'll just put it off a little bit more. What are they going to do? Politicians, they will do the latter. Always, always, always. And the great lesson from the German hyperinflation following the First World War was that there were in the government economists who had a better grasp of what was going on than the current economic establishment. They were all part of the whole system of the collapse because it was driven by economics. And indeed, Karl Helfrich, who at one stage was a finance minister during the First World War, and subsequently was still very close to the government and advising government ministers and all the rest of it, he knew that this was happening. He knew why it was happening. His status as an economist was similar to that of Keynes, for goodness sake.
Politicians publicly promise fiscal discipline while quietly expanding deficits because recession is politically harder to survive than inflation. Germany's hyperinflation era included economists who fully understood the danger, yet policymakers still chose currency debasement over immediate economic pain. As Alasdair Macleod points out here, the real driver is not economic ignorance, but political incentives that reward, delay, stimulus, and short-term stability at any cost. That means investors waiting for governments to voluntarily reverse course may be trusting institutions structurally incapable of doing so before confidence finally breaks. Next, Alasdair Macleod reveals why even informed governments historically failed to stop monetary collapse once the political cycle took over.
He was the man who also devised a way to get out of the problem eventually. It was slightly different, it worked in a slightly different way. He came up with a plan to base the new currency on the value of Germany's corn output, which was a similar sort of thing to the eventual solution. But even though they were better advised, the politicians of the day were considerably better advised than, say, the Trump administration or any administration that might follow the Trump administration or precede it, Germany still destroyed its currency. It was inevitable. And that, I'm afraid, points very clearly that our experience is unlikely to be any different.
Nobody discusses how late-stage currency rescues usually arrive only after public trust has already been destroyed. Germany eventually stabilized its monetary system with asset-backed reforms, but only after catastrophic wealth destruction wiped out savers who trusted official reassurances too long. As Alasdair Macleod points out here, the terrifying lesson is that policymakers often understand the crisis perfectly and still fail to stop it, because politics overrides economics until collapse becomes unavoidable. For gold and silver investors, timing matters more than prediction once confidence cycles begin accelerating.